everyone, and welcome to the Buck Stops here. I am Catherine Murray, and I am at home this week, just given COVID protocols. We're all trying to be very, very safe, but great to be with you, and certainly starting off 2022 with a number of unknowns, specifically surrounding, of course, inflation, the hottest readings we've seen in CPI and PPI in decades. And of course, we've got that at the same time. We have a U.S. Federal Reserve that looks to be hiking rates this year, could be 2, 3, 4 times, and also pulling back the balance sheet of the U.S. Fed. So a lot going on. It's had the markets in a bit of a wait and see holding pattern, but more to the downside of anything. So let me bring in my guest. This is Pat Ryan, who is joining us. He's got over 40 years of experience in the financial markets with a key focus in the commodities sector, having set prices for commodities that do not trade on an exchange. This is actually where most commodities trade, not on an exchange. Quite interesting there. And he has advised institutions, including hedge funds and pension funds around the world. Pat, great to be with you. Thanks so much for joining me.
Great. Thank you, Catherine. It's great to see you again. And most important, it's great to see you back on the air. I've always enjoyed your programs.
Thank you. I appreciate that. And I love being with the News Forum and having my own weekly show where we really get to have deeper and longer discussions, Pat, which, is always, I think, really warranted. First and foremost for so many investors right now, and not even just if you're an investor or not, the rate of inflation and the interest rate environment affects everything that individuals and families have to deal with, right? I mean, it sets your credit card debt, your auto loans, your investments, it sets the risk parameters. So that's why we kind of want to have this in-depth conversation with what the heck is going on with inflation and what the U.S. Federal Reserve is going to do or not do. So with that said, what do you think?
Well, one thing we know, inflation is not transitory. It might slow down a bit, but it's still going to be extraordinarily high. And the prices that we have seen, the inflated prices we've seen, aren't going to go away. So they're already locked in. Now you have a situation on the other hand, where wages and everything else are not going to go up is the same rate of inflation. I mean, it's going to be a completely different dynamic than we had in the last 5 years, because we had virtually no inflation, and now we have extraordinarily high inflation. So when we had this conversation yesterday privately, I started doing research in the last time we had a high inflation rate, and that was in the last 2 years of the Carter administration. And at that point, the then chairman of the Fed, Arthur Burns, was not going to be reappointed. And they reappointed a rather unexceptional person called G. William Miller to head the Fed during a high inflationary period. And Carter basically told him to tame inflation. Now, the Carter administration and G. William Miller were probably not suited for that task. What Miller did was, while he did raise the rates, it was incrementally small. And as a result, it had absolutely no effect. The inflation rate got even worse. They had, when you go up a quarter of a point, it's like a big yawn. Now, on the current situation, when the Fed and Jay Powell says he's going to raise rates, it's a very squishy term. I mean, there's no indication of how many rates he's going to increase. Is he going to do it 4 times, 3 times, 2 times? Again, it's squishy. And what's even more squishy is how much he's going to raise it by. If it's going to be a small incremental thing, which is, the cautious way to do it, probably the inappropriate way to do it, it's going to have no major effect. It will still have high inflation. It's not going to, but on the other hand, it's not going to increase the government debt or the payments on Social Security, which is another thing. This is a very political situation, and this administration has not been particularly good at handling political situations. So for the economy, it's really much more of a wait and see, but the inflation that we see today is not going to go away. It may slow down. It might not be 7%. Next month, it might be 6% or 5.5%, but you're just going to have a rate of inflation much higher than what the Fed said at 2% through this year.
Okay, a lot to pick up on there, Pat. We're going to take a quick break, and we'll be right back with Pat Ryan. All right. So Pat, you're saying that, look, we're going to have inflation. It's going to be higher than the U.S. Federal Reserve had predicted, or anybody perhaps. But you don't seem to be too concerned about it, or are you? And the reason why I'm asking is because, if in fact they have to raise rates faster, we're going to see the equity markets sell off, and that's what the equity markets kind of, started the year on a downtrend for sure, stabilized a little bit, and then we're seeing some downward trends once again. So, how are you really thinking about this? Are you concerned?
I would be crazy to say I wasn't concerned. But the uncertainty is that, well, we know the prices aren't going to go down. Logistics might get better. So therefore, there'll be more material available. But, there's the threat of stagflation, which is a real threat right now. As an investor, I'm not that panicky. The reason why is there's really nothing good else to put your money into. I mean, when you talk about income inequality, which is a big thing, at least in the United States, probably in Canada too, when you think about what the Fed did in the last year was actually increasing income inequality more than any other thing, because anybody who was invested in the stock market, and usually those are the people with some financial sophistication and some people with knowledge of the market or 401k plans, made money. Those who were relying on just their incomes and don't have any money in the equity markets, they got killed. They really did. So, in fact, when the government started throwing money at people, the United States government throwing money at people, some of these people went out and invested in equities. The GameStops of the world, the United Cinemas. So as a result, I mean, it's going to be worse for people on the bottom end of the equation rather than the top end of the equation. And there's really no good way where you can't put your money in debt. I mean, right now, even if interest rates rise, it's not going to be much above the rate of inflation as it is. So the equities are still a good investment. You just have to be picky on which investments you want to get into. I tell everybody that those investments those companies that are able to pass along price increases are the ones that are going to be the ones that win. I mean,
Right.
if they have annual contracts or really locked into things, I mean, they're not going to win. Those companies that can pass along higher wages and higher costs are going to outperform the market of those who can't do it. I think that's the general thing. The second thing is I'm looking.
Yeah,
Go
well,
on.
we're gonna get to some of the investment ideas in a second, but I think it's important though, because you mentioned stagflation, and you seem to say it's somewhat of a real concern. Most people I speak to don't think that we're anywhere near stagflation, but it's my biggest concern actually. And
Okay, it's my biggest concern
hopefully
too.
I'm completely wrong. So
Well, no, I don't think you're completely wrong. I mean, first of all, I've lived through stagflation. What happened in the Jimmy Carter era was we had stagflation. We had high prices, but we had little activity. Now, what's going to happen when this COVID situation calms down again? I think the last time we were talking about was a U recovery or a V recovery, but we had an L recovery. It went shooting up immediately as people started getting normality back into their life, and it was completely unexpected. Now we don't know what's going to happen when the Omicron virus starts really receding, or will people still be hesitant to do. So I see stagflation as a real concern because people are afraid of overspending. I think they're going to be more cautious of spending. But like I say, these prices we have, the milk prices, the housing prices, the car prices, every factor in the cost of living index is not going to go down. They're not. No one's going to start increasing the amount of potato chips in a bag because they have less money. Because there's more supply on it. So in reality, no, I think these prices are locked in, and it's the ability of people to pay for these prices, these goods and services. And if their salaries don't increase at the same rate, that's when you're going to have the stagflation. So I'm worried about more than anything else. I'm with you, Catherine. I don't understand the people who aren't worried about it.
So few people are worried about stagflation. I mean, they just really brush it off. Um,
Yeah, but
you know,
they've never lived through it. They've never lived through it. That's the thing. It's easy to brush it off when you haven't been investing in the market at that time.
yeah.
Unfortunately, I'm cursed with knowledge.
Okay, wait. Thanks, Pat. We're gonna leave it there. We'll be right back.
Okay.
Pat, you always make me laugh. So we left off on you're cursed with knowledge. That's what most people actually want, knowledge. But let's talk about this. Like, and again, I don't want to be too in the weeds here and boring or nerdy or what have you. But stagflation, I mean, it's important. So let's make sure we describe what it actually is. Over to you.
Okay, it's very simple. It's high prices and less demand. So, what happened is when you have inflation, people want to buy things usually because they know the price will be higher tomorrow. And as a result, that encourages growth. The problem is when you have stagflation, you have high prices, but people don't have the money to buy. So therefore, the high prices don't go away, but the demand does. So therefore, you have a stagnant economy coupled with high prices, stagflation.
Okay. And you also don't have the wages that can keep up with those high prices.
Again, when all these companies negotiate their wage increases, they're dealing with the past. They say, okay, inflation went up 5%. It's like when the United States government announced that the 2022 Social Security payments would go up 5.6%, which everybody thought was an incredibly high number, and it was a strong number based on the rate of inflation at that time. But don't forget that was for 2022. As soon as December's numbers hit, it was 7%. So they're already underwater. So that 5.6% doesn't even cover what the new cost structures are. And
Right.
that's not going to go away. As inflation keeps going up, even if it doesn't go up a huge percentage, just an incremental amount, they're still stuck with 5.6% for all of 2022. The same thing with wages. Any wages are always reactive rather than proactive. So when these companies announce big wage increases, bang, it's already lost with inflation. So their buying power keeps decreasing. Now, when you have something like the big factors are food and energy. If food and energy prices keep going up, that gap continues to widen because those are the essentials. So all the discretionary money dries up because they're so worried about putting gasoline in their car and cereal on their breakfast table that they don't have money for discretionary purposes. So therefore, you have that problem of high prices because they're not going to go down, and you're going to have slowing demand, stagflation.
Got it. And Pat, though, what gets us out of that situation if that's the situation we end up being in? Now, I speak to a lot of economists and strategists, very well-known people, including yourself, of course, and bond traders, and many would say, again, people are not worried about stagflation, and they actually say that COVID is very deflationary. And you had a really interesting comment about this the other day when we were speaking offline that maybe COVID is deflationary, but not when you have a government that, prints trillions of dollars.
Right, that's it. It is. If you look at the idea of what the pandemic did, it was in the first quarter and second quarter of this year, of 2021. It was deflationary, and the reason why the inflation rate was so low is because people weren't able to buy anything. They were locked in the basement, sort of like you in your house right now. Okay.
Thanks.
But
Yeah.
but as soon as they got out of the house in late third quarter, early fourth quarter, I mean, it was a renaissance, a splurge of spending. So therefore, we went from a deflationary circumstance to a highly inflationary circumstance within months. So therefore, instead of having a V recovery, I said it was an L recovery because it just shot up. That's it. So we had that euphoric buying thing. So therefore, yes, I could say a pandemic is deflationary. But I could also say when that ends, it's highly inflationary. And that's how I look at it. You just can't make a general statement on it.
Yeah, but it's difficult because there's so many moving pieces and parts. It's hard to know, where we really level out in terms of people just getting so excited to be out of their house and therefore they're buying. Maybe this all does kind of, simmer out a little bit. No?
Well, again, one thing we know, change is constant. And I think that's what everybody has to understand that. Also, there's an economic concept called adaptive expectations, where you view the future in the past or in the present. So therefore, this is what's going on today, and it's going to be this way in the future. And one thing this has taught us that you can't view the future based on the present.
We're going to leave it on that note. Thanks, Pat. We'll be right back. All right, Pat, you were just talking about adaptive expectations. You can't view the future based on the present.
Well, again, look, everybody looks at the past. That's not the question, or the present. And that's the thing they know. It's like forecasting the thing. It's easy to forecast production because there's a limited amount, but you really have a trouble forecasting demand because you have such a large amount of people in it. So therefore, you go with those factors that you know about. So okay. Yes, but the idea is if you have something strange come across, like a pandemic, the past is completely useless on it, and that's the key. But again, you start looking for opportunities based on the current situation. When you talked about investment strategy, the two things I looked at for 2022 and 2021 was those stocks that did really well during the pandemic. I want to be out of. Okay. Because we know that Omicron is going to go away probably sometime in the second quarter. So you're going to have recovery stocks. Those stocks did well before COVID rather than during COVID. The Pelotons of the world are never going to recover, no matter what they do. Because, again, that was a great COVID stock. COVID stocks, if it really does go away and it doesn't recur again, it's not going to be the same investment opportunity it was before. So you start looking at stocks that perform well. So that's one sector of stocks that I was looking at. Okay. This other sector of stocks are what I call the orphan stocks. And those are the stocks that people ignore. And my favorite group of orphan stocks are coal stocks. And coal. The reason why...
No, Pat, nobody talks about coal anymore, really. So coal. Okay.
And the reason why is that everybody, all the major corporations and some of the hedge funds want to get out of it for political reasons. But the world's going to continue to need coal, huge amounts of coal for the foreseeable time. So why they get out is an opportunity for other people to come in. And these people are more socially uninclined to worry about environmental reasons. They want to make the buck. They want to get their money back. So therefore, I think they're going to outperform the market. I think that, energy is too large, but energy is going to do very well. But I think my favorite, other than the stocks that did well before COVID, is coal stocks. Our coal stocks, I should say.
And where's the demand for coal coming from?
We're not going to get look. Nuclear power is decades away. In fact, alternative energy is decades away. As much as we want to say that it's here, we could prove that it isn't here. It's going to take a long. All you got to see what's going on in Europe, Spain, and France, and Germany to realize how dependent they are on thermal power. That's it. It's socially unacceptable. But people have got to make a decision whether they want to have air conditioning, whether they want to be able to charge their mobile phones, or whether they want to be green. That's it. And right now we have the best of both worlds, but it's not. The greener we get, the higher the more stress will be put on the economy because of lack of power. And that's what the real problem is. And I'm betting for people opting for power rather than green power.
Right.
And that's the reason I'm going for that area.
Okay. And just real brief here, like one of the big risks, we only have about a minute left, Pat, but when you think about geopolitics, because we always have to talk about that as well, you're really focused on Russia and Kazakhstan and the relationship with China as well.
Oh yeah, we're lost. Most people don't realize we've lost. I mean, you've already got the access of quote unquote evil. If you want to think about it, we have China and Russia basically working together. One of the largest producer of energy, and one of the largest consumers of energy, working for their own purposes. I mean, and I can see there's an alignment with Iran too. I mean, that's it. Now, the difference between the United States and these three countries is because they have greater control. And I'm not in favor of dictatorships, but we're a fractured. The United States is a fractured country. NATO was a fractured organization. When you think about it, what would the United States really do if China invaded Taiwan and Russia invaded Ukraine? We could sanction them, but that would be very difficult. I mean, the United States is no longer the power it once was. We have to accept that.
We got to leave it there. And we could keep talking.
Catherine, we always could keep talking.
I know. Thank you. We'll see you soon.
Thank you, Catherine.
Thank you.